Hi, everybody. As the title tells us, Chapter 3 is about gross income. What do we include? What don't we include? And it's interesting and it gets a little bit complicated. This is one of those chapters where you really need to read the details. We could be talking about salary, interest, dividends, or a variety of other things. Learning objective number 1 tells us when and how to record income. Well, first of all, there must be an economic benefit. You've got to be better off when the transaction is over. Number 2, a transaction must actually have reached a conclusion. Transaction must. Hi, everybody. As the title tells us, Chapter 3 is about gross income. What do we include? What don't we include? And it's interesting and it gets a little bit complicated. This is one of those chapters where you really need to read the details. We could be talking about salary, interest, dividends, or a variety of other things. Learning objective number 1 tells us when and how to record income. Well, first of all, there must be an economic benefit. You've got to be better off when the transaction is over. Number 2, a transaction must actually have reached a conclusion. Transaction must occur. Simply owning an asset that has increased in value does not create income. For instance, if you own your house and you could assess the value at the end of the year and it's gone up by $50,000, that's not income. Number 3, the income must not be tax exempt. And that's obvious, just makes logical sense. Learning objective number 2 tells us that as opposed to accrual accounting, which many of you will be familiar with if you took bookkeeping or you took accounting 201, where you recognize without realizing, and the realizing part was the cash part of the transaction. In accrual accounting, we can do that. In cash method, income can be realized in any form, whether in money, property, or services. So almost all individuals use the cash receipts and disbursements method. So that's what it is. And number 3, taxability of the components. So now we're going to talk a little bit about the components of gross income. The first component, interest income. Interest is compensation for the use of money with respect to a bona fide debt or legal obligation. And most interest is taxable. Unless, of course, it's non-taxable. It's stated non-taxable. Next, dividends. Dividends are a partial distribution of the profits by a corporation, not necessarily in cash form. Dividends typically are taxable based on the, there we go. The Jobs and Growth Act 2003. Dividends and ordinary income were taxed at the same rate, but as of 2017, this was President Trump's Tax Cuts and Jobs Act, the following rule applies. A married couple filing jointly with less than $80,000 of taxable income, head of household less than $53,600, and married filing separately or singles reporting less than $40,000 in dividends, $40,000 in income rather, dividends are excluded. Moving on, we look at state and local tax refunds. Now this becomes a little interesting because if you deducted state or local taxes on your Schedule A in the previous year and then you get it refunded, you must report the refund on the following tax return. Unemployment compensation is taxable. except in 2020. And you'll remember that was one of the parts that we were talking about in the homework for Chapter 3. Social Security benefits, taxable based on the filing status of the taxpayer. The effect of the rule is to exclude Social Security benefits from taxation for lower income individuals, but you tax as much as 85% of Social Security for higher income people. So that takes care of. Then there are finally the other income items: jury duty, prizes and awards, forgiveness of debt. If a taxpayer borrows money, it is not taxable income because the taxpayer must repay the loan. And certain insurance proceeds. Learning objective number 4 talks about items excluded, so non-taxable items. Some of those non-taxable items are, for example, employee fringe benefits. So services that are provided to an employee, spouse, or dependent children, but it can't cost the company any more than it would to provide it normally. Discounts on company services or products. And of course, de minimis benefits. This includes the traditional, I don't know, my company never did this, but the free holiday turkey on Thanksgiving. Other exclusions are things like employers can pay for up to $5,250 of educational assistance, whether or not it's job related. Payments under written dependent care. Costs of employer paid meals and lodging are tax exempt if it's furnished for the convenience of the employer. So for example, if the employer sends you on a job somewhere to go see a client, all of those benefits that you receive on that trip are non-taxable. Other non-taxable items, things like scholarships and fellowships, life insurance proceeds, gifts and inheritance. And then there are other things such as, for instance, child support. It's not taxable to the recipient. It's also deductible by the payer. Now, I've been in the general discussion group and I've seen people asking questions and being confused or needing help with something, with homework. Please don't hesitate to contact me. You have my cell phone number. I take text messages from all of my students at pretty much any time of the day, sometimes to the consternation of my wife. I also set up Zoom meetings as office hours. So if you want to have a Zoom meeting, I've got one today. We can sit down, we can go over the homework, we can go over a chapter, we can answer any question that you might have. So please feel free to contact me if you need some help. That's why I'm here.